Andrew, thank you for taking time being with us today. Tell us a little bit more regarding your background and how did you get into real estate?
Yeah, I used to be a chemical engineer, but that wasn't always my calling. I knew that was just kind of a placeholder until I figured out what I really wanted to do. And so I got married, and my wife and I tried a bunch of different businesses. They all made a little bit of money, but nothing was really creating that much income or wealth, or felt like we really enjoyed it that much. And then we discovered real estate, and went and started trying to flip houses here in Southern California, which is where we live. And I did the first one, and it went really, really well. So I quit my job, and then we went into flipping houses full time here, and did that for about 4 years, maybe 5 years. And then in 2009, 2010, we said, hey, this has been really good, but it's not going to last forever. So what's kind of we asked ourselves, what's the next thing that's going to start a big upcycle? And they said, well, all these people are losing their houses, and they got to live somewhere, and they're going to have to rent because they can't get a mortgage anymore. And then we're in a recession now, but when the economy starts to grow again, what does well? And I said, well, that's apartments. And so we bought our first apartment complex in 2011. We didn't personally buy it. It was syndicated, which means we brought in investors for it, and then we do all the work and run the deal and reposition it. And then we've been doing that full time ever since. So in the last 6 years, we've done just under 1,700 apartment units, and that's what we do full time. And it's been great for us and our investors, and we love doing it. So.
Tell us about early on regarding your first flip. How did it went down? How did you got the deal? How did you do the thing?
The first flip was just a single family condominium, and it was a gentleman who was in pre-foreclosure, which means he hadn't made his mortgage payments, and the bank was going to take his condo, but they hadn't taken it yet, so he still owned it. And so we reached out to him, tried to see if there's any way for him to keep it, and he had no documentable income, or so he had to sell it, and he knew that, but he kind of waited to the last minute. And so like the day before the bank was going to take it, he reappeared and called in a panic. And we were able to satisfy the bank, get them brought current, and then, close the transaction like a few days later. And then, so he actually walked away. He had a small mortgage. So he walked away with a good amount of money. And then we went in and we renovated it, and as quickly as we could, and turned around and resold it. And so that was basically the first single family deal.
But how did you put the capital for the deal together? It was a subject to, it was a carry back. How did you do it?
Yeah, it was subject to, so that was a big piece of it. And it was funny. So getting started that was our first one. We did not have the money to do it. So I remember we opened escrow, and the escrow agent she asked like 3 times. She's like, okay, I understand what you're doing, because subject, we're doing subject to and all that. And we explained that. And she kept asking, she goes, all right, this all makes sense, but one thing I don't get, where's the money coming from? And I just kept telling her, don't worry about it. We'll have it, right?
Magically appear.
Yeah. So so we had to, we had to give the seller $140,000 cash, and I had no idea where we were going to get that money at the time, right? So being our first deal, I had actually asked a realtor we knew to come down to escrow and meet us there, just for guidance and questions and everything. And so we walked out the door, and I turned to them. I said, hey, do you guys have like 100-something grand you'd want to invest? and they looked at me, and they just kind of and they're like, no, but we know someone who might, right? And so they introduced me to a guy, and the next day we had all the money for the property. And that guy funded every deal we brought to him for the next 5 years.
Cool.
Yeah. So, it really, it kind of gets back to, you hear people say, find a great deal and the money will show up. You don't want to count on that. And it's definitely better to have the money in advance. But it is very much true. If you have a great deal, you will be able to find a way to get it funded.
But we agree or disagree, because I don't think that happens until they trust you, because no one, even if you have like this great deal, and until you have someone that actually sees that you can perform and looks at you as a believable person and trusts you that you're going to do well, I think that's the only way they're going to give you capital. Would you agree?
Well, trust is certainly a huge part of it. And so for that first one, it wasn't just a stranger out of the blue, right? It was, we
Sure.
had, we had realtor friends, and then those people referred us to this guy who
Gotcha.
also knew a lot about real estate. And so he looked at the numbers and said, okay, this is a great deal, so he can't lose. And so, yes, there was some trust factor built in because it was a referral.
Gotcha. And from the first one, how did you went about in starting getting some deal flows? The second one and the third one and so on.
At that time, we were reaching out to, again, people who were in pre-foreclosure, and it was basically, we would get the list of people who had gotten behind on their payments, and we'd reach out to them either by, try to contact them on the phone first. If that didn't work, I'd go knock on the door and just say, hey, I'm here to help. I understand you might be in a difficult situation. Is there anything we can do to help? And just reach out to and try to help as many people as possible, with the idea being, out of every 100 people I talked to, 99 of them, we're going to figure out some way for them to keep their house or just do something else. But, 1 out of 100, they're just going to be like, you know what, I have to sell this thing, and you've been trying to help me and seem trustworthy, so I'm just going to sell it to you. So that's how we did the deal flow. In the beginning, it was slow because we were learning the process.
Sure.
And of course, it picked up down the road. And then, like I said, in 2010, 2011, we saw things were going to be slowing down, and said, and then made the shift out of single family into apartments.
But when these deals, can you run us through the numbers?
Let's see. I mean, you're talking, those are
the typical one.
10 years ago. So, I mean, it might be something like, let's say we're picking it up, if you fix it up nice, it's worth 400, and we might buy it for, 275, and, put $20,000 worth of renovations into it. And then said, go ahead and turn around and sell it for 400. So, we're not making $100,000 on it. We're still, we use a realtor when we sell it. So you still pay the realtor. There's all the title, the transfer taxes, the holding, HOAs, the cost of money, because we pay our investors for the cash we're using. But generally speaking, when we were flipping single family houses, we were aiming for a 15% profit, meaning 15% of the resale value. Sometimes it would be lower, sometimes it would be higher. So
these distressed properties, the idea was the seller was like, okay, I'm going to sell you the property, and he's going to leave? Or did you have some cases that he actually became your tenant because he was leasing the property that he sold you?
No, every one of them, the person was leaving. Yeah.
Gotcha.
And depending on their situation, we'd give them, some people were out before we even closed. Other people, we gave them 2 months. It just depended on what their needs were.
And what's the typical time until you got some new tenant in? Because I ask this a lot of people that flip houses, because here in Portugal, it's like you don't actually know when people are going to actually rent you the house. So doing this and then not having a source of income, meaning a tenant leasing the property. So I just want to know if you usually short, it's a time period that you have to carry the property until you have someone in.
Well, again, we were flipping these, so we never leased any of them out.
Gotcha.
So yeah, so we didn't do that. But I mean, Southern California, the rental market's very tight right now. So a decent property that's well marketed, you should be able to get a new tenant within a couple of days. I mean, it's not easy. It's not difficult to rent stuff right now.
Gotcha. And these properties, since it's in California, what's the typical? Because 400K, it's quite a large number. So it's a B property, or?
Well, again, we're talking, these are single family houses.
Gotcha.
So, and actually the median condo price in Southern California right now, I think is like 485. So 400 is actually on the low end. Okay. It's pricing gotten a bit crazy out here. So, but a $400,000 condo, yeah, it's probably in a B neighborhood.
Okay, so these are usually people with jobs and some income stress issue, and then they have to foreclose, and then you take over the property, you flip it, and you sell it. Okay.
Yeah.
And
yep.
How did you make the transition from flipping properties to having income properties?
Yeah, the income properties, would be the apartments, and the first one we bought was a 92 unit apartment complex on the other side of the country. So that's it was like 2,700 miles away. And so how we did that is the guy that we learned the single family business from, we just basically really went to him and said, "Hey, do you know anybody who could teach us the apartment business?" And he's like, "Actually, I do." And it was a guy he'd bought about 800 units, and we just approached him and said, "Hey, would you be willing to, could we hire you to teach us the business?" And we did. We hired him as our mentor for a year. He taught us the business, and we got along. What happened is we got along really, really well. So that once the official paid mentorship was up, we were friends, and so even 6 years later, we're still in regular communication. Partly because we've done everything went so well that we partnered up after he helped us through our first deal, and I think we've done 5 or 6 deals together now. But again, going back to that first one, is because we had someone to help us learn the business and guide us through. And again, and on that first deal, he did help bring some investors in because we were new at it, so we didn't have as near the investor base that we do now. And that is what made it successful, is having someone else to learn from and guide us through it.
But run us through the numbers on that income property, debt service coverage ratio, break-even ratio, cap rate. If you remember.
That was, the numbers on that. So that was at the bottom of the market. That was a heavily distressed deal, which I would not recommend anyone do as their first deal. So, I can give you the numbers on that, but that was 6 years ago, so it's not relevant to today's market.
Just a ballpark, just to for our listeners to get a hold of exactly what the typical deal that you're looking for that makes sense for you guys.
Today or back then?
Back then, of course.
Oh, back then. Okay. So, back then, that property was, I think we paid $7,600 a door for it, which is incredibly inexpensive, but it was very distressed. It was like 75% vacant. So there was no cap rate because it wasn't a profitable
Sure.
property. And we bought it for 750. We put I think we put about 750 into it to get it renovated. And then once we got it renovated, it actually did cash flow pretty well. I don't know what the debt coverage ratios or anything were, but it was probably 2 or 2.5. It was pretty high. And then we actually last year sold that for, I think it was 1.9 or something like that. So, yeah, that one. But again, I cap rates and all that. So stable. Last year we probably sold that on a 7.5% cap rate, but it wasn't that part of the reason. That's actually a high cap rate for right now, and part of the reason for that is that property is in not a very economically strong area, and we're trying to get out of those type of neighborhoods because some of the early properties we bought, like that one in particular, were in weaker neighborhoods. We sold all of those off. We don't participate in those neighborhoods anymore, but that's a big factor into why those numbers were the way they were.
And where was the property located?
That one was in the city called Macon, Georgia.
Okay, so and this is out of state investing for you. So as you know, this channel, it's all about foreign investment in the US. How would you do it if you were just looking at properties right now? Because I know cap rates are getting a little bit compressed now, and it's getting good deals now. Good deals now are harder to come by, and you see brokers,
definitely.
Yeah, and you see brokers making. I understand it's their job, but it's kind of laughable because you see projections like in the 10 years in the future, and like nothing is going on, and rents will keep increasing, but that doesn't make any sense. So I would like to hear your take on what's the numbers that you're looking for in order to provide a good source of income for your investors.
Right now, we look at what I call stabilized value add deals. So what that means is I'm not going to buy something that's 75% vacant, but what we will buy is something that's 95% occupied, maybe some deferred maintenance, meaning it needs to be painted, the landscaping is not very good, and the interiors haven't been updated. They're old, right? So when we buy it on day one, it already cash flows. So you've got a relatively low risk there. and then we're going to go in and we're going to spend maybe $5,000 a unit and maybe $10,000 a unit on the high end, and clean up the property and then raise the rents. Generally, on those kind of deals, we're raising rents anywhere from 18 to 35%, depending on the property and the market. And then by doing so, we're not counting on the market to keep going up. We're just looking at a deal and say, okay, if we can get this property and take it from where it is now and just bring it up to its full potential in today's market, regardless of the market going up, then number one, we've got great cash flow, we've created a ton of equity, and we have a big cushion in case something does happen in the market a year from now or 5 years from now or whenever that's going to be. No one really knows, right? So that's the kind of deal we do now. When you want to talk cap rates and returns, generally we're underwriting to a 15% IRR or internal rate of return, which means if you from day one to the day we sell it, take all those cash flows and also it also factors in the time value of money, meaning money in the future is not as valuable as money today, right? So we underwrite to a 15% IRR. As far as actual cash on cash, meaning, okay, if I put in $100,000, how much am I going to get out this year? Year one, it might be 4, 5, 6, 7% because we're getting things started. Usually by years 2, 3, and 4, we're targeting low double digits. It could be 9, 10, 12. We've got some that are 16, but it really is asset dependent, and it varies. But that's what we're targeting when we look at deals.
And you're looking for C type to B type as a value add?
C plus to B. Yep. And then the definition of that kind of varies by market, but that's generally what we're looking for.
Gotcha. And regarding loan to value, because if we are on the top of the market now, as S&P 500 has reached all-time highs and the Dow Jones as well, so it would make sense not to have a typical loan to value like 75 or so. Would you kind of lower the loan to value, like say at 50%? Because if you're looking to that in the next 10 years, if something was about to happen, you weren't so levered.
It depends, because on an acquisition, meaning something that we're just buying right now, we still do shoot for the 75% of loan to cost, because we know that as long as we execute our plan, the value of that property will be much higher even without the market going up.
Sure.
Right? Because we know we can put in $1 million and then create an extra $3 million worth of value. So, but by the time we're done, that leverage is dropped, right? Because we've increased the value of the property. And that's one of the things I really like about apartment complexes is, with single family, you're just riding the market, basically. I mean, it's single family pricing is determined by sales comps. Did the house down the street sell for more or did it sell for less? With apartments, there certainly is a big aspect to it that's market reliant, but the other big piece of it is you. And that is, if you can increase the net operating income of that property, you've just increased the value of it, regardless of what the market, is going on with the market, right? So we have a huge piece of it that's under our control. And so by the time we do that, that leverage has gone down. So I'll give you an example. We have one in North Florida that we bought 2 years ago. When we bought it, we got a loan that was 75% of the purchase price and 75% of the renovation. So when you put that all together, the loan was probably about 90% of the purchase price. So 90%. So today, that property has appraised less than 2 years later. That property has appraised for more than double what we bought it for. And we're refinancing it, taking most of the money back out, and we're only refinancing it at like 63% loan to value. So in the beginning, the leverage is a little bit higher, but that's because we're buying undervalued assets. And then when we refinance them to hold them longer term, yes, we do. We try to stick to roughly 65% or lower and not be too aggressive with leverage at this point in the market cycle.
And regarding holding period numbers, what's the typical holding period, and where do you usually refinance the property?
Our goal is typically to refinance by the end of the second year of ownership. It's possible that we could do it earlier. It just depends on how quickly we were able to get the property turned around. And then for the hold period, it's typically 5 or 10 years. Again, it depends on the asset. Some of them make for better quick turnarounds, and some of them make for better long-term holds. It just depends on what's going on in that market. But with that said, we monitor the local market very closely. And if it makes more financial sense to sell early or to wait longer, then we'll evaluate that and do that. And so how they're structured is, so if we put together a deal that says, all right, we're going to, the pro forma says we're going to sell this in 5 years. And, in year 3, we feel like, the market might be turning and something could happen, then we would take a vote of the investors. And if the investors, a majority of the investors agree with us, then we'll go ahead and sell it. But we've also had situations where it came time to sell the property, and the property's doing really well, that market's doing really well, and we took a vote, and it was unanimous. So I just said, no, don't sell that, just keep it, because everyone's getting, everyone's getting checks every quarter for free almost at this point. Actually, it is at this point. So generally it's a 5 to 10 year, but we were careful not to lock ourselves in where we have to sell in year 5 no matter what's happening, because that's part of how you can get in trouble, right? It might not make sense to sell in 5 years. It might be better to wait till year 7 or sell early in year 3.
And regarding rents, how do you evaluate what's the rent that the property should be renting for? Because if you are doing a value add, you look at the property and saying, okay, so we have rents that are like this, and we probably can raise rents up to this. I'd like to know 2 things. How do you evaluate that, okay, this property can rent like with this values, and how long does it usually take you to do the actual value add on the property? That's 2 questions.
How long it takes to do the value add it depends on the size of the property. It's easier to do a 90 unit than it is to do a 290 unit.
Of course.
We're typically targeting 15 to 18 months to have the entire thing done. So usually we'll have the outside done in the first 3 months. Like we just go in, we'll have 10 projects going at once and just do the landscaping, the painting, anything on the exterior is done immediately. And then for the interior units, that's what takes longer, because we don't believe in going in and just emptying the property out and kicking everyone out and then doing the renovation. We do it as units become vacant, so as leases come due. So just that naturally is a 12-month process. And then you're going to have some people that for whatever reason takes a few extra months or just some special situations. So 15 to 18 months is generally the repositioning, and then we want to give it a few months of we call seasoning, meaning everything's done, the rents are raised, cash flow is great. We want that to have 3 or 4 months of that showing on the financials, so that when we go to the bank, we can say, hey, look, here's how this place should be valued. So that's the time frame. How we determine what those new rents are going to be is we just do a pretty detailed study of all of the other properties in the market, right? So we'll say, okay, within a 3 or 5, even 5 mile radius, pull up every other apartment complex in that market. And then we actually take that data into Excel, and we do some scatter charts where we plot, the rent versus the size of the unit, and kind of look at how every unit in that market is laid out. And what we're generally looking for is there some kind of gap where the property where it sits today, is there somebody in that market that is achieving much higher rents with a similar unit that's been renovated? So if we've got a 1980 property and the one next door to us is very similar and they're getting $300 a month higher rents because they did some renovations, well, that's a pretty clear indication that there's some opportunity for us to do the same. Or we might be buying a C plus property that rents for $600 a month, but there's an A property next door that rents for $1,200 a month. Well, we're never going to compete with that. We're never going to get to $1,200. But if there's enough demand in that market for an A-class property next door to get $1,200, then that means we can renovate and probably get $800 or $900. So it just means that. So that's another piece that we look at, is not just the comparables. We look at the median income in the area and say, okay, well, if we bring the rents up to X level, is that going to be affordable to the people that live in that market? If the answer to that question is yes, then even if you don't have good comp data, that's a pretty clear indication that it'll work, because if it's affordable for people and you provide a good product, they'll typically go for it. Another good thing to look at is you'll find some properties where they might already be kind of near the top of the market, but and then what we call this is proven value add, where let's say there's 100 units and they renovated 3 of them, and those 3 units are renting for $125 more a month. Well, that shows right there that, if you continue to do that, you should be able to do that on, if not all of the units, a good chunk of them. So it shows, okay, if you rent, I go in and I improve these units, there are people in the market who are willing to pay an extra $125 for it.
And also regarding the project, because if 200 units, that's a lot of people. So how do you organize the actual project managing in order to get the actual value add done? It's like you gather a team of people, you just deliver it to a couple of contractors. How do you usually do these?
Yeah, that is the tricky part, or one of the tricky parts, definitely. So,
Sure.
we're set up. We have some in-house crews that can travel from property to property, but in most cases, it's a combination of we use third-party property management, and they have a couple of renovation specialists that's all they do within the property management company. So in most cases, it's a combination of those guys, and then they will work with certain subcontractors. And then I also have some fairly sophisticated general contractors that we've used a number of times, we have a good working relationship with, and that we can trust. And many times they will just take over large portions of they might do everything on the interior, for example. Right. So instead of having, electrician and a plumber and a painter and a carpet guy and all, the general contract, he just handles all of that and then just bills us, directly. And then as part of it, as asset manager, my job is to track all of that spending. We have weekly conference calls and we have spreadsheets where we track the progress of all the projects and all the renovations and how much it's costing versus how much we budgeted it. What is the procedure if something comes up that's unexpected? And, all of that is tracked. So it's managed with, again, good general contractors, renovation specialists that are part of the management company, and then then all the spreadsheet and pricing, budgeting stuff I do on my end. And then I do go out, and visit the properties on a regular basis. Despite the fact that it's a couple thousand miles away, one of the benefits of living near LA is there's lots of direct flights almost anywhere. So I can get out there pretty quick when I need to.
But who determines how much carpet, how many lights, and the full 9 yards until you actually have an accurate estimate exactly what's the actual cost of the renovation?
That's part of the due diligence process. So when we're getting ready so when we've got an offer accepted,
sure.
Well, let's just say it's 100 units, right? So we've got an offer accepted on 100 units. We've negotiated a contract. That contract is signed. So now both parties have agreed, okay, seller's going to sell it and, Andrew's going to buy it. So usually within a week to 10 days, I am on site and I have our management people are there. So they're going to do a full lease audit, and the renovation specialist guy is there. And then in addition to that, we have our contractors there. And so we walk the entire property. So we do the entire exterior, and I lay out what the scope is going to be. So I'll say, okay, we're going to paint this, we're going to add gutters, we're going to do this landscaping, whatever. And then all those contractors, they will put together the bids and send me. So one contractor might say, okay, I can do the gutters for 30,000. Another contractor say, well, I can do them for 28, whatever. So I already have an estimate in my head of, okay, this will probably cost 30,000, but then we'll get actual bids during the due diligence process, so that by the time we're closing, I already have firm numbers on what everything's going to cost. And then for the interiors, when we're doing due diligence, we walk literally every single unit. So if it's a 100 unit property, that means that day we're going inside 100 units. If it's a 300 unit property, over the course of a couple of days, we will go inside all 300 units. And so we have tablets that are all interconnected, that have spreadsheets. And so as you walk through the unit, we can just put into the tablet, okay, this needs a new bathtub, needs a new stove, needs new door hardware, needs to be repainted. Oh, this one needs new carpet, and it syncs in real time. So that, because we're broken up into teams. And by the time we get to the end of the day, every single unit has been walked and a spreadsheet has been built that lays out what needs to be done in every single unit, and then we just apply the pricing to that, and it gives us a pretty good estimate of what needs to be done and how much it's going to cost.
And how many people do you need to walk 100 doors?
You know, for 100 doors, we'll probably have 2 people sitting in the office looking at doing a lease audit and going through financials, and then we'll probably have 4 to 6 people walking interiors, and that does not include however many contractors we have out there.
Gotcha. And regarding contractors, I'm not they are a pretty unreliable bunch. So at least here in Portugal, you have to be aware of, and not to say I didn't tell you. So how do you screen them, and how do you assess that they are going to do what you told them that has to be done?
Yeah, you know, and unfortunately, what you alluded to about contractors definitely applies here in the U.S. As well. In fact, it's probably not much different. And part of it too, just in contractors' defense, you know, just what happens is that someone might be a really good electrician, but that doesn't mean they're a really good business person. So sometimes it doesn't translate. And then also, you know, a big part of it is, as the owner or the person hiring the contractor, you know, how well do I communicate what the scope is, what the expectations are, how things are going to work. So that's a big piece of having a good relationship with your contractor. But how we find them, you know, at this point, it's always through referral. So, you know, again, you know, today, whenever something comes up, we know who we're going to call. But if we didn't, let's say I'm going to a brand new market, right? And I need to find contractors. So what I'm going to do is I'm going to go to our property management company. I'm going to go to the brokers that I know, and I'm just going to say, hey, you know, I need to repaint this property. If you were going to do that, who are the top 2 painters or contractors you would call to do it, right? Because they're going to, you know, they're going to refer, because they want to protect their own reputation. They're going to send me to somebody that they trust, and ideally that they've used, that they've had a good experience with. And that doesn't guarantee that it's going to work out well for you, but it certainly heightens the odds. And so I'll take that referral list, and I'll interview them. I'll have them do bids, and, you know, and the bidding process is part of the interviewing and screening process, right? If you have 3 contractors go to your property to give you a bid, and, you know, there's one guy where you're having to hound him 10 times, hey, when's the bid coming? Are you going to get, you know, that's probably not the guy you're going to want to work with. But if you get the guy who goes out there, you know, he says he's going to be there Thursday morning. He's there Thursday morning. He says, I'll have the bid on Monday. The bid shows up on Monday. You know, it's detailed, it's specific. That's a good sign that guy might be the guy you want to work with. And I found that to be the most effective way to get those contractors. Nothing is foolproof. Even then, sometimes people change. Contractors that start off great, a year or 2 down the road, you have to end up ending that relationship. And then I've also had contractors that started off kind of so-so, and, you know, we had a good heart-to-heart and said, look, this is what, and all of a sudden, you know, after that, they did really well. So referrals is kind of the bottom line, though.
Gotcha. And regarding macroeconomics, what do you look for when you are thinking about purchasing a property in some in some state?
We are looking for, I mean, the big 2 are population growth and job growth. We want to be in areas that people are moving to. So in the United States, the general migration trends for the last at least decade, and in some cases 50 years, is from people to be moving from north to south. And so people are moving from, like places like Chicago and New York and those down to places like Atlanta and Houston and Dallas, Fort Worth. And then people are also moving out to the West Coast, so California and Oregon. Seattle's been booming, San Francisco, LA, San Diego. So we look for where people are moving and then where the jobs are. So, you know, we do a lot of stuff in and around Atlanta. because both the population growth and the job growth is above the national average in that area, and it's becoming a very diverse economy. So that's on the highest level. That's what we're looking for.
Also, regarding Section 8 and Section 42, we've been getting a lot of those from brokers. So do you look at these types of properties? What's your sentiment on these types of properties?
So by Section 42, I'm assuming you're referring to the low-income housing tax credit properties?
Yes, and some of one other thing regarding the Section 42s, usually they have a rent increase restriction.
Yes.
So if you take over the property for the next so years, you cannot increase rents. And I'm interested to know what you think about this.
We don't do them, period. So, and again, that's a special niche. And there's some guys out there who do really well working in that space. It's just not for us because it's tough. It's a lot tougher to do value add because, like you said, you're restricted on how much you can, bring up the rents. And again, when we're not just going in and just buying a place and just automatically just raising the rents. We're spending a lot of money. Our goal is to raise the rents, but deliver a better living experience. And not just arbitrarily make it more expensive. Well, it's really tough to do that with the tax credit properties. Also, the tax credit properties, there's a huge amount of regulatory requirements that you have to comply with. And so it actually takes, in most of those properties, you have to, especially if it's a larger one, you have to hire a person full time just to do all the extra paperwork. And then, so we just don't do that. That's just not something, it's outside of what we want to own and operate, and we don't do it. For Section 8, Section 8's a little bit different. That is, so a low-income housing tax credit property, that means the entire property, generally speaking, is restricted. So you can only rent to people who make a certain income, and it's targeted towards the lower income brackets. Section 8 is a bit different because I would imagine a lot of your listeners might not be particularly familiar with exactly the vagaries of U.S. law. But so for Section 8, what that means is that person, and Section 8 refers to the section of the code that comes from. But a Section 8 tenant is a person who has a voucher from the government that says the government will pay a certain amount of their rent, and they can go anywhere they want to live. They're not restricted, but the government will pay. So they might have a voucher that says government's going to pay $500 of their rent. Go find a place, right? So that's a lot of owner operators like Section 8 because if the person, the rent money is coming from the government. We've actually tended kind of away from Section 8. Most of our properties no longer take Section 8. A couple of reasons for that. Number one, a lot of the lenders don't like it. If you get more than 10 or 15 or especially 20% Section 8, the commercial lenders don't like that, and it can be tougher to get a loan. Then also what we found is in trying to bring up the level of these communities, maybe take it from a C to a B, having Section 8 makes it more challenging to do that. Not that all Section 8 tenants are bad. There's some great people on Section 8, but there's a good percentage that does tend to be a more difficult demographic. And then what happens is a lot of the higher level demographics that you're targeting and trying to bring in won't come live at a property that has Section 8. So it's just kind of a business decision whether or not you take Section 8. So if we take over a property that has Section 8, we don't just like kick them all out. But what we do is we stop taking new Section 8, and then just over time it kind of naturally goes away.
Gotcha. And actually, I forgot to ask you something important regarding value add. We got a deal coming our way that I noticed that the water costs were way too high, and the overall total operating expenses were about, I think it was 77 or 78% instead of the 50s. So what I would like to know is, how do you, from this first point that you only have the offering memorandums, you're just looking at a property from like this higher level perspective, how do you know that you actually are able to reduce the operating expenses to a more interesting level so you can increase NOI, and not just being plain arrogant because you just think you can actually do better than the other guy was doing?
That's an excellent point, and you phrased it really well in that it's foolish to just automatically assume you can somehow do better than the other guy, right? Because I mean, odds are he's trying, right? I mean, not very many people run their properties way more expensive than they have to just for the heck of it. Although it does happen, oddly enough. So that is one of the challenges, especially if it's your first property. I would be extra careful in trying to not assume that. And candidly, properties where the bulk of the value add comes from running it cheaper than the other guy, that makes me a little bit nervous because again, I want to make sure we're not being arrogant. But at the same time, there's things you can do. So we of course work with our property management company manages 23,000 units. So they have a vast amount of experience in our market, and they know where what generally speaking the expenses should be. So I'll do that. In fact, I was just looking at one yesterday, and they went and checked it out for me. And so before they went to visit, I said, hey, look, I said, when I look at the expenses for this property, some things really stand out to me. Number one, their payroll is much higher than it should be. Their landscaping is much higher than it should be. And their advertising is much higher than it should be. So when you look at this property for me, that one of the questions that I asked them to answer is there something specific about this property that if we buy it, we will have to have this higher than normal expense? Or when we buy it, can we lower this expense and make it an opportunity? So, in some cases, it's pretty clear cut, like, let's say the water bills seem kind of high, and we'll ask, okay, has the property had a water saving program done? Well, if the answer is no, then I know I can go in and put low flow toilets, low flow fixtures, and I can reduce that water bill by 25%. So that's a factual thing that, yes, I will put that in the underwriting. But for some of these other things, let's say I'm not sure, like the payroll or the landscaping, I will have somebody local that I trust basically verify and say, okay, well, they're spending $1,300 a unit on payroll. It should be $1,100 a unit. So could you, please double check and see if there's any reason why we shouldn't be able to run it cheaper. That's a really important thing is if expenses are high, the key is to find out why are they high. Sometimes, on the payroll, here's a good example. We found properties where the property manager has been there for 20 years and they just got a pay raise every year. And because they've been there for so long, they're getting paid 50% more than the market, so it doesn't need to be that way. So we can bring in a new manager that's,
Sure.
excited and green and getting paid. We actually do try to pay our people well, because number one, it's the right thing to do, and number two, there's a lot of value in that. But so again, that's if you can find the reason for it, that's the trick.
Gotcha. And regarding the tenants, because since they are kind of the primary source of income, how do you assess that the same tenant's not having some issues regarding their job? So do you screen them on an annual basis? How do you have any sorts of metrics that you can be safer that guy living on 12B will keep paying the rent?
So when we own a property and we're screening new tenants, we have very strict parameters on who will get approved. And it's generally stuff like, their income has to be at least 3 times the rent. They have to have been at their job for, at least 6 months. They can't owe any previous landlord's money, stuff like that. So if they get approved and they move in and they're paying their rent on time, then no, there's no annual, rescreening or anything like that. It's basically once they pass the initial approval and screening process, as long as they're paying their rent on time, then they're fine. Now, when we buy a property and we inherit 100 people, what we do is when they come up for renewal, then we screen them, because for us it's the first time to screen them, and if they don't qualify, then in many cases their lease won't be renewed.
But when you do the contracts, let's say you take over a property, we are like on the 25th or something. When we reach the 30th, do you automatically increase the rents increased, or how do you do this process? Because I would imagine someone is going to leave, right? If you just automatic raise increase.
Well, typically we're not just doing automatic rent increases. Usually we're doing some renovations and adding, value to create a better living experience. However, we are bound by the lease that we're taking, so if we buy 100 units, those 100 residents are all on leases, typically 12-month leases here. And we are legally bound to honor those leases. So if someone, just signed a lease 2 months ago and their rent is $500, we have to keep their rent $500 for the next 10 months. We can't just automatically come in and raise the rents unless they're on month-to-month leases. Then you can do it on a shorter time frame, but that's typically pretty rare, especially on a larger property. You might find something like that on a 10 unit or a 20 unit, but most of the bigger properties, 80 units and bigger, everybody's on a 12-month lease, and you can change the rent as that lease ends and comes up for renewal. And that's generally how we do it.
And how do you collect rents? Do you use ACH? Do you have some automatic process of debiting rents directly on their bank accounts? How do you do it?
Yeah, that's all handled by our third-party management company, but we do, in some properties we accept credit card payments. All properties accept money orders, and we do prefer to do, if there's a way to do it like automatic debit or ACH or credit card or something like that. We don't accept cash, and most cases we don't accept checks. But yeah, credit card, ACH, direct deposit, stuff like that, money orders.
And at this time, where are you guys looking for good deals? Because lately I've been getting some super expensive stuff and does not make any sense at all.
Yeah, that is the toughest part these days is getting good deals, and it really comes down to relationships. So, where we get our deals is typically brokers that I've worked with for 4, 5, 6 years. We've done good deals with them. They know what we're looking for. They know that we do what we say we're going to do, and so they'll call me and say, "Hey, Andrew, I just talked to the seller and in McDonough, whatever town, and it's 120 units, and he'd like to sell, and I think it's a good fit for you, and let's just see if we can put a deal together, right?" And that's the deals that we actually end up buying. That's typically how they come about. The deals where you get an email blast from a big broker and there's this fancy offering memorandum and all that. We never end up buying those. Not that they're bad properties, but if you've got 20,000 people literally 20,000 people looking at it, the odds of me being the highest bidder are pretty low. And then 2, if I was the highest bidder, I'm going to be worried that I missed something, right? Because there's a lot of demand out there. So there are good deals to be had and to be found, because there's always special situations. But I mean, that's what you're looking for nowadays, is you've got to have a good relationship with the people, the brokers largely, that are out hunting the deals and talking to the sellers. And you've got to be willing to just look at deal after deal after deal. We probably buy one property for every 100 that I look at.
But do you get deals daily? It's like 10, 20 deals daily. How's the deal flow
gotcha.
for you?
I probably see 10 properties a day in my email inbox, but 9 of those are either stuff we won't buy, or it's overpriced, or 20,000 people are looking at it. I might get 2 to 5 deals a week that have serious potential. But then even those, we most of them don't pan out. It takes a lot of sifting through right now to find good deals. They are still there. It takes a ton of work to find them, because there's, number one, there's fewer available, and two, there's more people looking for them.
So for someone starting out and listening to us, would you advise them to keep pounding on doors and starting getting relationships with brokers, or you just tell them to wait a little bit and then start doing something?
Well, you know, for your listener base, for, you know, people listening to your channel, I mean, you're talking about, you know, basically investing overseas. So you're not going to be able to knock on doors. And candidly, that's not, you know, that doesn't really, that applies in the single family world, but not in the, you know, commercial world. So the best thing to do is really, that I would recommend, is to start forming good relationships with brokers. And you can, you know, and you don't have to worry about, you know, coming across as this perfect sophisticated investor. I mean, just be candid, and, you know, call them up and say, hey, you know, my name is Andrew, and I'm, you know, looking to start investing in, you know, the Atlanta area, and I'm getting to know the market, and, you know, I'd love it if you would send me, you know, these type of deals that you're seeing. And then, you know, they'll like, okay, sure, and they'll email you, you know, all their listings that they currently showed, you know, to 1,000 other people. And then what you do is you take those and you look through them, because, you know, and it's not a waste of time for a couple. Number one, because you know, looking at a bunch of properties that aren't deals helps you get better at spotting the ones that are good deals. But then number two is, what you do is you look at those, and then you call the broker back and you say, hey, thanks for sending this to me. I looked at it and looks like a nice property, but, you know, here's why it's not a good fit for me. You know, the median income's too low, or the crime is too high, or the price per unit's too much, or, you know, whatever the, you know, those reasons might be. And that's how you build that relationship. And then over time, as you continue to do that, they will start sending you the better and better deals. So, you know, again, especially being out of the country, that's the most effective way to do it. Is most of those brokers spend their lives building relationships with sellers and getting to know every owner in that market. And so as a buyer and investor, it makes sense to leverage the relationships they have. So by having a good relationship with one broker, you essentially are connecting yourself to possibly hundreds of sellers.
Gotcha. And for the future, where do you see yourself heading in your company?
You know, we really like the multifamily space.
Me
You know,
too.
there over the next, what's that?
Me too.
Yeah. You know, I mean, over the next, you know, a couple of decades, there will be recessions, there will be soft spots in the economy, but, you know, and then so there will be times where pricing comes down, there will be times where rents come down. But in the big picture, over the next few decades, the United States is becoming a renter nation. We are transitioning away from home ownership to more and more people renting. And again, in addition to that, the population is growing. So, you know, long term, you know, in fact, they just came out with a study that says they said by the year 2030, at our current pace, we'll be short 4.6 million rental units, meaning there's going to be not enough supply for 4.6 million people. And so basically, you know, what that says is the demand is going to far outstrip the supply of rentals for you know, the next decade and a half. So long term, I think, you know, multifamily is, you know, especially in terms of real estate, is the best place to be. I mean, if you own a commercial building, you know, with a you know, electronics store, and that electronics store goes out of business, you're hosed, right? You've got a vacant property. Well, if you've got a 100-unit apartment complex and one guy loses his job, you're barely even going to notice that, right? And let's say a recession hits and 10 guys lose their jobs. Well, what you do, number one, you should have enough cash flow where you can still be okay in that situation. But number two, no matter what's going on, people always need somewhere to live. So if you've bought it right and you financed it right and you're operating it right, you should be able to lower your rents temporarily so that you can stay full, and then just wait until the market picks back up. So, you know, those are some of the factors, and there's lots of other things too that I really feel good about multifamily long term. And again, I'm not saying that it's just going to be all sunshine and roses for 30 years straight. There's going to be some rough patches, but if done properly, you can not only just make it through those rough patches, but use those to grow and even thrive even more when we hit the next up cycle.
And going back, advice to your younger self, what would you say, Andrew?
Get into apartments even earlier. So yeah, I mean, really that's it. So I was a chemical engineer for 7.5 years. I went into that basically just so I could have a good income and a good job until I figured out what our real calling was going to be. And my wife had the same idea, and it took us after I started my engineering, it took 7.5 years to figure out that real estate was where we wanted to be. So if I could go back to my younger self, I'd say, okay, go get a real estate finance degree or something like that and start real estate as soon as you get out of college, because then I'd be 10 years ahead of where I am now.
Gotcha. And regarding books, what have you been reading lately that you would like to share with our listeners?
Well, let's see. Reading lately, I actually just finished Osborne's Wealth Can't Wait. For people who are interested in general wealth building, that's a good book. For those who might be interested in learning about multifamily, there's 2 books by a guy named Dave Lindahl. One of them is called Multifamily Millions and Emerging Markets. Those are 2 excellent books to get just a good kind of overview and sense of markets and in multifamily investing. Another really good one that I like is How to Win Friends and Influence People. Because no matter what you're doing, no matter, yes, it's numbers, it's finances, it's spreadsheets, but at the end of the day, you're dealing with sellers, you're dealing with brokers, you're dealing with tenants, and that's all relationships. So that's key. So then there's a bunch more I could mention, but those are somewhere where I'd start. And
finally, where can our listeners get a hold of you if they have any further questions?
I'm on LinkedIn. I'm on Bigger Pockets, and then of course there's a contact us page on our website. Our website is it's Vantage Point Acquisitions, and we don't have a fancy website. We don't keep it very well updated. We're more focused on making sure the properties are doing well, not having fancy websites. But it is functional. It's just V like Vantage, P like Point, ACQ.com. And there's a contact page on there where you can submit information, and that goes directly to my email inbox. And then, I try to reply back to those as quickly as possible.
Andrew, it was wonderful having you with us today. Hope to speak with you soon.
Yeah, it was great. I really enjoyed it. Take care.
Take care.